If you think this is just another spike at the gas pump, you are already behind. What is happening now is bigger than gasoline, bigger than the usual panic on television, bigger than one bad week in the market. I have lived long enough to know that when oil suddenly jumps and stays high, it does not stay inside the energy sector. It moves through freight, food, travel, wages, confidence, hiring, credit, and finally into the daily life of the middle class. That is the part most people miss. They see oil as a commodity. I see it as a tax collector. I see it as a silent hand reaching into every household budget and taking a bigger piece before anybody has voted on it. And when that hand gets strong enough, it does not just slow an economy. It reshapes behavior. It makes families postpone purchases. It makes employers hesitate. It makes weak businesses crack. It makes investors emotional. And when investors become emotional, wealth starts changing hands. That is why I want to walk you through this carefully. I want to do three things. First, I want to explain why oil shocks have such a brutal habit of showing up before recessions and why this one deserves more respect than most people are giving it. Second, I want to show you how higher oil moves into the job market at exactly the same time artificial intelligence is already rearranging employment. That combination matters more than either story by itself. Third, I want to show you how I would think about investment opportunity when the headlines are loud, the market is jumpy, and ordinary people are starting to feel squeezed. I am not interested in scaring you for entertainment. I am interested in making sure you do not walk into a storm, pretending it is only a light drizzle. I have seen enough cycles to know that history does not repeat itself in a perfect costume, but it usually comes back wearing familiar shoes. Over the last half century, we have seen major oil price shocks again and again. We saw it in 1973. We saw it in 1979. We saw it in 1990. We saw it in 2008. We saw it again in 2022. And now we are staring at another serious oil shock in 2026. Look at that list and you see a pattern that should make any serious investor pause. The shocks in 1973, 1979, and 1990 were tied to recessions. The 2008 episode was tied to a recession and then something far uglier than a simple recession. The 2022 spike did not end in recession, but one reason it escaped that outcome is that the shock did not stay extended for long. It flared hard, then cooled before it could fully poison the bloodstream of the economy. That distinction matters. The market does not simply care that oil went up. The market cares how long it stays up, how high it goes, and how much already brittle confidence it destroys while it is there. That is what makes 2026 so dangerous. Gas prices have jumped sharply over a short period. Households feel that immediately a family can delay replacing a phone, a family can delay a vacation, a family can delay buying furniture. But they cannot completely avoid filling the tank, paying a shipping cost hidden inside groceries, or absorbing higher transport and energy costs woven into almost everything they touch. Oil does not just raise one bill, it raises the cost structure of life. If diesel goes up, shipping becomes more expensive. If shipping becomes more expensive, food becomes more expensive. If fuel becomes more expensive, airfare becomes more expensive. If oil stays high, fertilizer and agricultural inputs become more expensive. If those costs stay elevated long enough, businesses either raise prices, eat their margins, or cut something else. Usually that something else is hiring, expansion, or labor. That is how a commodity becomes a social event. People who have never opened an annual report still end up living inside the consequences of oil because oil works its way into the price of almost everything that moves, gets manufactured, gets delivered, or gets consumed. That is why I always tell people not to treat oil as a narrow sector story. It is a system story. And right now the system is already fragile. Inflation was already an issue before this new shock. Household budgets were already tighter than people like to admit. Credit had already become more expensive. Savings rates were not exactly inspiring. Confidence was already thin. Then oil showed up and pressed directly on the bruise. Some of the loudest voices in finance are now throwing out extreme possibilities. One view is that oil ultimately collapses lower if demand breaks hard enough. The other is that the world gets stuck with very high oil for long enough to drag the global economy into recession. Those are not mild outcomes. Those are the kinds of outcomes that force repricing across markets and behavior across households. And the brutal truth is that nobody knows which path comes next with certainty. What we do know is that the shock is real. What we do know is that it is already filtering through expectations. What we do know is that if this lasts, it becomes a tax on the middle class. A wealthy family can absorb a higher fuel bill, a more expensive flight, a pricier grocery basket, and a higher utility bill with annoyance. A middle-class family feels it in choices. That is where the real damage begins. The middle class gets wiped out gradually before it gets wiped out visibly. First, discretionary spending gets cut, then savings stop growing, then debt becomes harder to service, then big purchases get postponed, then household confidence falls, then employers feel the slowdown, then layoffs become easier to justify. Then the news starts calling it a downturn as if the thing arrived overnight. It never arrives overnight, it builds. That is why I pay so much attention to the chain reaction instead of one dramatic headline. The first link in the chain is obvious. Higher oil means higher costs. The second link is consumer behavior. People spend less when essentials take a bigger slice of the paycheck. The third link is business revenue. If consumers buy less, companies make less. The fourth link is employment. If companies make less, they stop hiring as aggressively, cut projects, reduce hours, or eliminate jobs. And that brings me to the part of this story that I believe most people are still underestimating. This oil shock is not hitting a calm labor market. It is hitting a labor market that was already being rearranged by artificial intelligence. That changes everything. If oil were the only problem, the economy might still absorb the hit with enough time and enough policy flexibility. If AI were the only problem, companies might still retool gradually, train selectively, and spread the pain over a longer period. But when both hit in the same window, the pressure does not just add up. It multiplies. I want you to think about it this way. Higher oil weakens spending power. Weaker spending power pressures company revenue. At the same time, AI gives management teams a reason to say, maybe we do not need as many people to do this work. That is a very dangerous combination for the marginal worker. When executives are under margin pressure, they become disciplined very quickly. If they were already experimenting with replacing simpler tasks, routine tasks, entry-level tasks, or repetitive digital work with AI systems, an oil-driven slowdown gives them cover to move faster. Let's put it, the layoff is not just about technology. It is about efficiency. It is about uncertainty. It is about protecting profits. It is about getting lean. That is the language of every tightening cycle. The worker on the receiving end still loses the job. I want to be very clear about something. I do not think AI means there will never be work again. That kind of thinking is lazy. Human beings adapt. New roles emerge. Better tools can create better output. Strong people often become stronger with the right tools. But the transition still hurts. And transitions always hurt the people who are standing in the path of the first wave. That is what matters today. Many firms are not saying they will never hire humans again. They are saying they need fewer humans doing simple work and more humans who can supervise, think, judge, and build around the machine. That may be sensible from the boardroom. But at the economy level, it still means dislocation now, and now add oil. A company facing weaker demand from the consumer and better automation inside the business has two incentives pointing in the same direction. Spend less on labor. That is why I think it is a mistake to analyze the 2026 economy with only one lens. People who look only at oil miss the labor reshuffle. People who look only at AI miss the spending squeeze. The real danger is the overlap. The economy can survive one problem. Two problems arriving together can turn caution into paralysis. You can already see it in confidence. Consumers do not spend based only on what is in the checking account. They spend based on what they believe about the next 6 months. If they believe the job is safe, they will stretch for a car, a vacation, a bigger home, or a discretionary upgrade. If they are uncertain, they freeze, they postpone, they delay, they protect cash. That shift in psychology is not a side note. It is the engine of slowdowns. When sentiment falls low enough, the economy begins to contract before the government data is even ready to admit it. And that is one of the great traps for ordinary people. They wait for official confirmation. They wait for economists to name the problem. They wait for 2 quarters of negative GDP to arrive in a tidy package. They wait for the recession headline. By the time the label becomes official, the market has usually spent months repricing. Businesses have already adjusted, and the strongest opportunities have often started to emerge. That is why I care more about the mechanism than the label GDP matters. Of course, it is one useful scorecard for how much spending is happening across the economy. If spending rises, the economy grows. If spending weakens enough for long enough, growth slows or turns negative. 2 consecutive quarters of decline is the formal definition many people use when they talk about recession. But GDP is a lagging portrait. By the time the official numbers arrive, the families living inside the slowdown already know. The small business owner already knows. The recruiter already knows. The trucking company already knows. The retailer already knows. The investor who studies behavior instead of waiting for permission already knows. That is the mindset I want you to have. I do not want you trapped in a world where you only believe what has already been printed in a government release. I want you watching the living economy. Are households acting richer or poorer? Are employers acting bolder or tighter? Are consumers reaching or retreating? Are businesses raising prices because they are strong or because their costs are squeezing them? Are workers being hired for expansion or being replaced for efficiency? Those questions matter more than the pretty headline that comes months later. Now let me talk to you the way I would talk to a serious investor sitting across the table from me. When the economy gets noisy, most people become children again. They want certainty. They want somebody to tell them exactly what the market will do next Tuesday. They want a clean answer about whether recession is guaranteed or impossible. They want permission to either panic or relax. That is not how real investing works. Real investing begins with a simpler question. What do you believe the world will look like 10 years from now? Do you believe the American economy will be larger or smaller than it is today? Do you believe productive businesses will still exist, sell things, earn money, and compound value over time? Do you believe good assets bought at more attractive prices are usually better than the same assets bought after the crowd feels safe again? If your answer to those questions is yes, then volatility is not your enemy. Emotional behavior is your enemy. That does not mean every price decline is an opportunity. Some things deserve to fall. Some businesses are weak, over-leveraged, badly managed, or built on fantasies. I am not telling you to buy nonsense because the chart went down. I am telling you to distinguish between temporary fear and permanent impairment. That distinction is where fortunes are made when the market is anxious about oil, recession, layoffs, inflation, and geopolitics. Broad quality assets will often get sold along with fragile ones. That is where disciplined people separate themselves from emotional ones. The first category I would think about is the broad American economy itself. If you believe the United States will still be larger, more productive, and more profitable over the next decade, then owning a broad slice of the strongest businesses remains one of the simplest rational decisions you can make. You do not have to play hero. You do not have to predict every move. You do not have to guess tomorrow's headline. You can own a large basket of productive businesses and let time do the heavy work. The key is behavior. Most people say they are long-term investors until prices fall, then they become short-term worriers. That is why I prefer systems. If I am accumulating a broad basket of quality businesses, I want a rhythm, weekly, bi-weekly, monthly, something automatic, something emotion does not get to vote on. When the market is up, I buy. When the market is flat, I buy. When the market is down, I buy. When the market is down harder and the crowd gets ugly, I buy more aggressively if my resources and conviction allow it. That is how compounding gets fed, not with predictions, with disciplined repetition. Some people call this dollar cost averaging. That is fine. I do not care what label they use. I care that the investor keeps buying good productive assets without letting headlines interrupt the process. The second area I would think about is cash flow. There are investors who do not only want long-term appreciation, they want assets that pay them while they wait. I understand that instinct. There is psychological strength in watching capital send cash back to you. High-quality dividend payers, especially when accumulated sensibly during fear, can do that. But again, quality matters, balance sheet matters, payout safety matters, business resilience matters. You do not want yield for its own sake. You want durable businesses with the capacity to continue producing and distributing cash over time. The third area I would think about in an oil-driven slowdown is defense. Some sectors are less glamorous and more stubborn. Consumer staples are not exciting dinner conversation, but they have one beautiful habit. People still buy basic necessities in good times and bad times. Toothpaste is not canceled because sentiment falls. Soap does not disappear because GDP slows. That does not make every staples company a bargain at every price. It simply means that some categories of business endure pressure better than the crowd imagines. The fourth area I would think about is insurance. And when I say insurance, I mean something most people misunderstand badly. Gold, I have never liked the way gold gets marketed to frighten people as if it were a magic ticket. It is not. Gold does not build a factory. Gold does not invent a product. Gold does not create an operating margin. Gold does not compound in the same way a great business compounds. But that does not mean gold is useless. Gold has a role. Its role is not to act like your best business. Its role is to act like distrust made visible. When people fear inflation, war, monetary disorder, or financial stress, gold often becomes attractive because it sits outside many of the promises other assets depend on. I do not treat it as the engine of wealth. I treat it as a form of insurance, a form of hedging, a form of reserve against certain kinds of systemic anxiety. If you use it that way in moderation, and with the right expectations, you are being sensible. If you use it as your whole plan because you are in love with doom, you are not investing. You are rehearsing a disaster fantasy. The fifth area I would think about is what actually benefits if oil stays high. That is where energy enters the conversation. If the conflict drags on longer than people expect and energy remains elevated, the companies tied to that cash flow can benefit. This is not complicated. If the product price stays high, many businesses associated with producing or supplying that product will earn more. The mistake is not in seeing that. The mistake is in chasing the theme after everybody already piled in and pretending risk disappeared. Energy can be a sensible part of a thesis. It can also be a brutal trap if you buy at the wrong price with the wrong expectations. The investor's job is not just to identify what may benefit. The investor's job is to compare that possibility against valuation, cycle risk, and durability. And then there is another path people should not ignore. Technology. This might sound strange in a discussion about oil, but it belongs here because the same period that is generating fear about recession is also continuing to build the next architecture of productivity. AI, automation, semiconductors, robotics, and the infrastructure around them are not disappearing because consumers feel shaky for a quarter. The long-term trend remains powerful, but trends do not rise in a straight line. They surge, overheat, disappoint, get sold, and then continue. That is normal. If I wanted exposure to the long arc of automation and digital infrastructure, I would not approach it with romance. I would approach it with selectivity and patience. The long-term case may be strong, but the short-term path can still be violent. That means I want position sizing, discipline, and the willingness to buy more only when the odds improve, not when the story sounds fashionable. That is the broader lesson here. Do not confuse a real long-term theme with a guaranteed short-term outcome. The market has a nasty habit of humiliating people who are directionally right but behaviorally undisciplined. Now I want to come back to the middle class because this is where the emotional truth of the story lives. The last time oil did this, it did not arrive at a time when households felt rich and unburdened. It arrived when strain could spread. That is what makes these episodes so dangerous. An oil shock does not just hurt poor households. It can hollow out people who appear stable on the surface, people with jobs, people with homes, people with retirement accounts, people with routines. They are the ones who discover that one more increase in everyday costs can break a budget that looked fine on paper. That is why I never want people using temporary asset values as if they were permanent wealth. Do not treat a market balance like a paycheck. Do not treat home equity like free money. Do not treat a bull market like proof that risk disappeared. Do not assume tomorrow's income is already guaranteed because today's job still exists. The middle class gets wiped out when it mistakes calm for strength. This is especially true when households are carrying too much lifestyle against too little resilience. If your cost structure requires perfect conditions, then you are not safe. You are exposed. And exposure is expensive. When oil rises, confidence falls, and employers start getting more efficient with fewer people. So what would I do if I were building my life and my portfolio through this kind of environment? I would do what I have always done. I would protect liquidity. I would avoid foolish leverage. I would refuse to panic sell productive assets just because the headlines got uglier. I would keep buying good businesses and broad baskets of strong businesses on a disciplined schedule. I would hold some degree of insurance against inflation and disorder without confusing insurance for compounding. I would stay humble about prediction and aggressive about preparation, and I would remember that the best opportunities rarely feel comfortable when they first appear. Most people want a clean sky before they buy. That is why they usually buy expensive assets. The investor who builds wealth is not the one who predicts every storm. It is the one who knows how to stand in the rain without losing his mind. That is the test in front of you. Now, if oil comes back down quickly, some of this pressure will ease, sentiment may improve, spending may rebound, the market may decide the whole thing was another false alarm. That is possible. But if oil stays high, if households keep pulling back, if AI-driven labor cuts continue, and if confidence keeps sliding, then the squeeze gets harder, the economy gets more brittle, and the market is going to keep offering both danger and opportunity in the same package. That is why I am not asking whether this feels scary. I am asking whether you are prepared. Do you have a system or only opinions? Do you own assets or just narratives? Do you know what you will buy if fear deepens? Do you know what you will refuse to sell if prices fall? Do you understand the difference between temporary discomfort and permanent damage? Those are the questions that matter, because the market does not reward the loudest voice. It rewards the investor who stays rational when the middle class is getting squeezed. The headlines are growing darker, and the crowd is once again mistaking volatility for the end of the world. This is not the time to be asleep. This is not the time to pretend one more dollar at the pump. It's just one more dollar at the pump. This is the time to recognize the chain reaction early. Position yourself carefully, and remember that every serious cycle tests the same thing in the end. Not your intelligence first, your temperament. And if you can hold that, if you can keep your head while costs rise, confidence falls, jobs get reshuffled, and the market offers you good assets at uncomfortable prices, then this period will not wipe you out. It will educate you. It will strengthen you. It may even make you. But only if you pass the test. Most people fail. When the pressure rises, do not reach for comfort. Reach for discipline.